Silver just punched through $110. Not a grind, a detonation. Mid-80s to above 110 in hours after Trump threatened Canada with tariffs. The dollar buckled. Risk flows flipped overnight. But here's what they're not showing you on the headlines. Lease rates spiked days before price moved. Retail premiums widened while dealers quietly rationed size. COMEX registered inventories bled out. ETF creations lagged the actual price surge. If you're holding silver, stacking physical, or just trying to understand why everything feels more expensive every single month, you're in the right room. Because what you're watching isn't speculation. It's flow. It's plumbing. It's the market's stress lines glowing red. Your job isn't to predict the top. It's to understand the structure underneath before the next headline hits. And there's one indicator flashing right now that historically only shows up before violent repricing. We'll name it. But not yet. Hit subscribe if you want to stay inside the room where we track signals early instead of reacting late. Drop a comment with where you're watching from. We're mapping this together. Not chasing hype, comparing notes. Here's what happened. Trump's tariff threat against Canada wasn't just political noise. It hit currency expectations hard. The dollar softened. Hedging flows rotated fast. Silver caught the bid. But the hidden layer? Lease rates quietly jumped 3 days before price broke out. Dealers widened their spreads. Industrial buyers didn't blink at higher prices. They kept pulling. That divergence is the first crack. If price leads sentiment, something underneath is already broken. The question isn't whether silver's overbought. The question is which market is lying. Paper or physical? We're going to teach you 2 patterns that repeat across decades. Then we'll give you the exact signals to watch this week. Let's go. First mechanism, the currency valve. When the dollar weakens suddenly, silver stops being a drip line. It becomes a fire hose. Think about it like this. Capital is always looking for the narrowest exit when policy shocks hit. Precious metals become that valve, not because they're magic, because they're liquid, portable, and don't answer to any central bank. Here's the flow. Policy shock hits. Currency expectations shift. Hedging demand surges. Futures markets feel the pressure first, then physical follows through. The valve opens. This isn't new. We saw it in 2008 when the Fed cut rates to 0. We saw it in 2020 when pandemic stimulus flooded the system. We saw it in 2022 when inflation data started running hot. Every time the dollar weakens fast, silver moves faster than sentiment can catch up. Not telling you to buy, showing you the pattern. Right now, Trump's tariff threat just cracked the valve open. The dollar index dropped. Risk hedging rotated. Industrial users didn't pause. They kept buying. That's the signal. When fabricators don't slow down even as price jumps, they're not speculating. They're securing supply. Circle this. If the valve's opening, the next question isn't how high price goes. It's how fast it moves before people realize what's happening. And speed matters, because in narrow markets, speed creates dislocation. Dislocation creates opportunity for those watching, and chaos for those caught blind. If this is the valve opening, we need to ask what happens when it can't close. Second mechanism, the physical squeeze loop. This one's street level. No theory, just mechanics. Here's how it works. Tight mine supply. Industrial demand from solar panels and electronics pulling hard. Fabricators start pulling forward orders to lock in metal. Paper markets are slow to adjust because futures traders trade momentum, not delivery schedules. Then the loop starts. Inventory drains, premiums rise. Dealers ration size. Price gaps up. Not mystical, mechanical. Imagine you're a dealer right now. You've got industrial clients who need 50,000 ounces delivered next month. Contract locked in at $92. But spot just hit 110. You're underwater before you even source the metal. So what do? You widen spreads. You ration new orders. You prioritize your biggest clients. Retail buyers? They wait, or they pay more. That's the squeeze. And here's where it compounds. If tariffs escalate, cross-border metal flows distort further. Canadian supply into the US slows. Premiums widen regionally. Arbitrage breaks down because logistics can't keep up. The loop tightens. We've seen this before. 2011, 2020. Same mechanics. Different headline. The loud move is price. The dangerous move is availability. Think about that. You can see a chart rip higher and feel late, but if premiums are spiking and dealers are rationing, that's not FOMO. That's structural stress. And structural stress doesn't resolve with a tweet, it resolves with supply. Or demand destruction. So here's the question you need to sit with. If paper price is rising but physical availability is tightening faster, which one breaks first? Let's connect these two patterns. The currency valve explains why capital flows into silver when the dollar weakens. The physical squeeze loop explains why price can gap violently even when sentiment feels cautious. But when both trigger at the same time, that's when things get unstable. Here's the compounding effect. Valve opens. Hedging demand surges. Futures markets absorb some of that pressure. But if physical inventories are already tight, futures can't deliver into the demand. ETF creations lag because authorized participants can't source metal fast enough. COMEX registered inventories start bleeding because longs stand for delivery instead of rolling contracts. Now dealers are caught. They're short physical, long exposure, and the paper market can't bail them out because the metal isn't there. That's the dislocation. Not a conspiracy, not manipulation. Just a structural mismatch between where demand is and where supply isn't. And the tell? Lease rates. When lease rates spike, it means someone needs metal now and they're willing to pay a premium to borrow it. 1-month lease rates jumping from 20 basis points to 200 basis points isn't normal. It's stress. We saw lease rates move days before this price break. That's the early warning. If you're watching lease rates, you're ahead of the chart. If you're only watching price, you're reading yesterday's news. Not advice, pattern recognition. So which market is lying? The paper market saying everything's fine? Or the physical market saying we're running tight? Here's what you need to sit with. The question isn't, is silver overbought? The real question is, which breaks first, price or availability? Because if lease rates stay elevated, if premiums keep widening, if COMEX inventories keep draining, then this move might not be late innings. It might be the second inning. And if the hidden indicator we mentioned at the start confirms this stress, then the crowd calling for a pullback might be waiting for something that doesn't come the way they expect. We're about to show you exactly what to watch this week, the signals that separate those who react from those who anticipate. Let's map the paths. Not predictions, frameworks. Escalation path. Tariffs expand beyond Canada. Dollar weakens further. Lease rates stay elevated. Volatility rises. Upside continues. Winners? Those holding physical with no leverage. Losers? Those short paper with tight stops. Cooling path. Political walkback. Dollar stabilizes. Lease rates normalize. Price consolidates but doesn't collapse. Winners? Disciplined traders who banked gains. Losers? Late chasers expecting another double. Dislocation path. Price stalls or dips, but premiums and inventories worsen. Stealth stress. Paper market and physical market diverge. Winners? Those watching flow, not just price. Losers? Those assuming a chart correction means the squeeze is over. Could reverse, could accelerate, could chop sideways for weeks while stress builds underneath. Your job isn't to know which path we take, it's to recognize the signals that tell you which path we're on. Can't know timing, only structure. Here's what I'm tracking this week. Not theory, tools. Signal 1. Silver lease rates, 1 to 3 month. Normal behavior, 10 to 50 basis points. Stable, boring. Stress behavior, jumping above 150. Spiking intraday, staying elevated for multiple sessions. What it means. Someone needs metal now. Not next month, now. And they're paying a premium to borrow it. That's tightness you can measure. How to interpret. If lease rates spike and stay high while price consolidates, that's hidden demand. If they normalize, the squeeze is easing. Signal 2. Retail coin and bar premiums versus last week. Normal behavior? 2 to 4% over spot. Regional variation but stable. Stress behavior? Premiums widening to 6, 8, even 10%. Delivery delays extending. Dealers limiting order size. What it means. Physical market is tight at the street level, not just institutional. Retail. How to interpret. Rising premiums while price dips. Buyers stepping in. Premiums normalizing. Supply catching up. Signal 3. COMEX registered inventory daily changes. Normal behavior. Slow drift. Occasional jumps in or out, mostly stable week to week. Stress behavior? Consistent daily drawdowns, large one-day moves, registered dropping while eligible stays flat. What it means. Longs are standing for delivery instead of rolling. Metal is leaving the exchange. That's tightness at the institutional level. How to interpret. If registered keeps bleeding while price rises, the loop is tightening. If it stabilizes, pressure is easing. Signal 4. Dollar index behavior after tariff headlines. Normal behavior? Headline drops, initial move, then reversion within hours. Stress behavior? Dollar stays weak. Follow-through selling. Currency desks repositioning for sustained weakness. What it means. The valve stays open. Hedging flows continue. How to interpret. If the dollar bounces hard, silver's move slows. If the dollar grinds lower, the valve's still open. Signal 5. ETF inflows relative to price momentum. Normal behavior? Inflows follow price with a 1 to 3 day lag. Stress behavior? Inflows lag badly or don't show up at all despite price surging. What it means. Authorized participants can't source metal fast enough to create new shares. That's a supply bottleneck. How to interpret. If inflows lag while price rips, that's confirming the physical squeeze loop. If inflows catch up, supply is loosening. Not telling you to trade these signals, showing you what to watch. Your job is to track them. Compare week to week. Build your own read. If you're in this market, here's the approach. Not commands. What we respect. 1. Size discipline. Volatility is real. Don't size positions assuming price only moves your direction. Respect whipsaw risk. 2. Liquidity awareness. Physical premiums can widen fast. If you're buying coins or bars, know your exit isn't instant. Plan accordingly. 3. Avoid leverage traps. Futures and options amplify moves both ways. If you're leveraged and wrong, you don't get time to adjust. You get stopped out. 4. Diversify time horizons. Some positions are short-term trades. Some are long-term holds. Don't confuse the two. Know what you own and why. 5. Mental hedges against FOMO. Missing a move feels bad. Chasing a top feels worse. If you didn't enter early, wait for structure. Don't let urgency override discipline. 6. Accept that you can't control outcomes. You can control your process, your signals, your risk. You can't control whether tariffs escalate or walk back. Build around uncertainty. Not advice, pattern recognition. If you're watching these signals, you're putting yourself in the group that sees cracks before headlines scream. Here's where we are. Silver ripped above 110 on a policy shock that flipped currency flows overnight. But the move wasn't just price. It was flow. It was plumbing. It was two patterns triggering at once. The currency valve opened when the dollar weakened. The physical squeeze loop tightened as inventories bled and premiums widened. And the hidden indicator? Lease rates spiking days before price moved. That's the signal institutions watch. Now you're watching it too. If you stay disciplined, Track the signals we just walked through, and don't let FOMO override your process. You put yourself in the group that doesn't get shaken out when volatility spikes. Markets don't reward prediction. They reward preparation. 2 asks. 1. Drop a comment. Are premiums rising where you are? Yes or no? Let's map this together. 2. Subscribe if you want to stay inside the room where we break down signals early instead of explaining them late. What's one signal you've started tracking this year that's helped you stay ahead? Share it. We're building this together. Links below. If you're holding, know what you own. If you're watching, know what you're looking for. If you're waiting, know what signal brings you in. Stay sharp. We'll see you in the next one.